Hey guys, it's Rudy coming at you live from Palm Beach in Florida. It is Monday. It is April the 8th, and I thought I would do something a little different today. Many YouTubers, not that I would necessarily call myself a YouTuber because I do it now and then, occasionally, and because I like it. Um, but many YouTubers basically tell you all about their successes and try to give you advice and try to give you stocks that you should buy and stocks that you shouldn't buy and whatever. I don't do any of that kind of stuff. I just share information with you and hopefully you can learn something, including learning from some of my mistakes. So over the years, and what I did was I went back 10 years and thought, you know what, why don't I share some of my biggest mistakes? Because most of the people on YouTube are always telling you how great they are. And how about I pause for a minute and tell you some of my monumental blunders that I had made in the past 10 years. Um, Hopefully, we're all a little smarter today than what we were then. But I'm going to share some information with you and then we see how we go, right? So, for a little bit of fun, let's look at some of my five biggest losers, right? But before we go into the stocks and I share some of that information with you, let's quickly take a look at this, right? So, Warren Buffett, probably one of the best investors of our time, said, I've made all kinds of bad decisions that have cost us billions of dollars. They've been mistakes of omission rather than commission. What he means by that is he's basically saying it's not so much what he had done, but perhaps what he had not done. He goes on to add that he didn't buy into Microsoft or Intel because he didn't understand those businesses. Now, that's something I actually learned from him. And I try for the most part to invest only in businesses that I understand, can easily comprehend. I can read their SKs and 10Ks, their 8Ks and 10Ks and so on, and fully understand what it is that they're doing. And for the most part, I can figure out from their corporate filings whether this is a good investment for me or not. I do that better today than what I did before. Boy, did I make some errors. I'm going to show you some in just a second. At the bottom here, he adds Fannie Mae was one that was within my circle of competence, right? So here he's talking about omission rather than commission. I made a decision to buy it and we just didn't execute, right? So I made a decision to buy it, but I didn't. Sometimes we make a decision to sell and we don't. And when we don't sell, sometimes we get lucky. And when we do sell, we can look back on it, as I'm going to do now, and say like, oh boy, was that an error? I should never have exited that particular position. Anyway, we would have made billions of dollars, but we didn't do it. He's talking about Fannie Mae. I'm not going to go into Fannie Mae. If you don't know what Fannie Mae is, you can Google it and look it up. Let's take a quick look at this. I'm going to just show you two quick slides, and I'll go into some of my biggest losers, right? So here I have pulled up DIA, DIA, which is an ETF, so an exchange traded fund that basically invests in the Dow Jones Industrial Index. Now, the Dow Jones Industrial Index, or the Dow Jones, is an index of 30 of America's greatest corporations. Arguably, there are some that are better than others in that index of 30 companies, and arguably, right now it's perhaps not the best mix of 30 companies. They could make changes, and they do from time to time, but not very often, right? The fact of the matter is this: the Dow as a 30 company index is a stodgy old index. And if you look back about 20 years or so ago, you would have seen that it was trading at around $77. Now, of course, ETFs have not been with us for a long, long time. And this was one of the first ones, basically just mimicking the Dow Jones Industrial Index. Currently, DIA is trading at around $389, so almost $400, and it was about $100 20 years ago. Now, you may, if you've been following my channel, you might have heard me say before that if you can grow and with compounded growth at about 15% per year, you can double every 5 years. So this one you could say has gone from about $100 to $200 and from $200 to about $400. So it doubled sort of every 10 years, which means it was growing at a compounded rate of about 7.5%, right? Half of 15, which is pretty good because if you're in the market and over that same period, you underperformed the Dow, then you probably could have done much, much better. Now, when you take into consideration my losers that I'm going to show you, you might say, so what did you do instead? Or what did you do with the money that you could have made on that particular investment? And that's called opportunity cost. I'll get back into that in just a second, right at the end. if you look at the Dow Jones over a longer period, right? So here we're looking at the Dow Jones over a period of about 50, 60 years or so. And the reason why I added these big red circles there is because there are events that sometimes cause um, retail investors, smaller investors to get fidgety and feel like they're losing everything and then they sell, which is very often at the wrong time. And very often when the retail investors get out, some institutional investors get in. Of course, I'm not saying institutional investors always get it right, but as a general rule, they buy and they hold. They don't necessarily flip in and out of positions all the time. Many of them can't do that anyway because they have to publish a prospectus every year to show you what they're invested in. So they don't have the ability to move in and out of stocks. People, with the exception of some lucky day traders who move in and out of stocks, in general, underperform the index all the time. These big red circles that I've added here, the three circles that I added, one was Black Monday, which happened, I think it was October 1998. The other one in the middle here was the financial crisis, and the most recent one being the 2020 pandemic, when they suddenly surprised us with a man-made virus and caused the market to pull back quite sharply before it rebounded again. If you look at it over a longer period of time, specifically over here, on Black Monday, the Dow Jones Industrial Index dropped about 20% in one day, right? If you can't stomach 20% in one day, then the market is probably not the right place for you to invest. Sometimes, I mean, if the market had gone up 20% in one day, you probably would have been happy. If it went down 20% in one day, if that made you feel uncomfortable, you should also feel uncomfortable when it goes up 20% in one day. Anyway, let's take a look at some of these. I'll give you some real examples, right? So here I'm going back just over 10 years ago. Valero, right? So today, if Valero is or were in my portfolio, I'd happily hold Valero. I don't have Valero in my portfolio, and obviously by now you would know which energy stocks I do have in my portfolio. But take a look at this because it's a real example. A $1,000 investment in April 2014 would be worth $3,372 today. Going back approximately 10 years, so around about 2024, I had 900 shares of Valero in my portfolio. And if I had held on to those 900 shares, it would have been worth about $163,000 today. At that time, it was worth about $47,000, right? So here you can see, not only, I mean, in theory, I didn't take a loss, right? Because I didn't sell it necessarily at a loss. I'm just showing you what would have happened if I had simply held the position and done nothing, right? Buy and hold. One day, someone asked Warren Buffett, what's the best time frame or period to hold a stock? And he said forever. And of course, no one really holds stocks forever, but that's what he said, right? But anyway, if I had done nothing and just held on to my Valero stock, my investment that was worth about $47,500 10 years ago would be worth about $163,000 today. But wait, it gets worse. Google. I actually had some shares in Google, only 30, which had a value of about $35,000, also approximately 10 years ago. A $1,000 investment in Google would have been worth $5,200 today. So I had $35,000 in Google 10, 12 years ago, and that would have been worth about 188 today. So even more than my Valero that I just showed you on the previous slide. How about Facebook? Well, when Facebook went public, I didn't buy it. And fortunately, I didn't because it pulled back very sharply from its IPO price, but then it recovered a little bit. And over time, I actually built a little position in Facebook until I had about 485 shares. That was worth about $30,000. This is just over 10 years ago. This was actually in January of 2014. So just more than 10 years ago. My $30,000 position, if I had held it and not sold it, would have been worth $194,000 today. So even products like Facebook, which is now Meta, that suck and probably should go out of business, would have been worth a lot more, almost 6 times more, more than 6 times more than what it is worth today. Another one, Amazon. So 10 years ago, 2014, I actually held a position in Amazon, and a $1,000 investment in December 2013 would be worth $7,782 today, which is an almost 700% gain. Now, I had about 90 shares of Amazon with a market value of about $32,000. If I had done nothing and simply held it, it would have been worth $252,000 today, right? So you can see this is an example of opportunity cost, right? Because when I sold it for whatever I sold it at the time, whether I took a loss or took some profit, what did I do with the money? And that's what I'm talking about when I talk about opportunity cost. Another one, this is the last one. So this company, Solium Capital, I was intimately familiar with. For the sake of transparency, I actually worked for Solium Capital for a number of years. This particular company was acquired by Morgan Stanley for $900 million, so almost $1 billion, making it a unicorn. When I worked for Solium, it was a startup, so I had a fistful of shares. I actually had more shares than the 28,875 that is on this particular page here. Morgan Stanley acquired the company for the equivalent of about 19 Canadian dollars or $14.50 or thereabouts in US dollars. And this particular position in this particular account had a value of about $219,000. If I had done nothing at all, it in theory would have been worth $416,000. Not today, because the company was sold in 2019, but at the time of the execution of the acquisition by Morgan Stanley, they purchased the company for $14.42 in US dollars per share, multiplied by the number of shares that I held at that point in time. I would have exited the position because the company was sold at $416,000, right? So there are times when you look at this and you say, I had an opportunity to potentially make a lot of money, and all I had to do literally with these stocks, excluding this one because it's a small cap company, but if you look at the previous four that I shared with you, so Amazon, Facebook, and Google and Valero, these are sort of mid cap or larger companies, and I sold them. And when I sold them, as I said, whether I took a profit or a loss is not really relevant. What is relevant is if I had done nothing at all, I would have been up substantially from the position value as it was as an unrealized gain at that point in time. So this is the principle of opportunity cost, right? So this is from Investopedia. It says the potential benefits that an individual investor or business misses out on when choosing one alternative over another, right? So it's very difficult to predict and to say to yourself, like, I should have done this, I could have done this, or whatever. Today, I don't do what I did those days, which is effectively look at a position when I was up 20, 30% in terms of an unrealized gain. I would often plug in a trailing stop. You can also think of a trailing stop as a covered call. And I would say, okay, I'm just going to trail the price, but as soon as it pulls back 3%, I'm going to sell it and then, just bank my profit. Now, the stocks that I just shared with you, with the exception of Solium Capital, which was my previous employer for a while, the stocks that I shared with you is pretty much the same modus operandi that I had deployed at that point in time. So 10 years ago, I was quite happy. As soon as the stock got to like a 20, 25% gain, I would plug in a trading stop and say, hey, if it pulls back 3 or 5%, just exit the position. And then I looked to buy something else. And I did this over and over and over again. If I had done nothing, I would have been ahead as opposed to where I ended up in terms of where I am today. The difference, though, is along the way, what I did was I studiously started focusing on particular areas so that I make sure, unlike Warren Buffett, who admits that he didn't know anything about Intel and Microsoft, so he didn't buy them, but he knew everything about Fannie Mae, and he still didn't buy that. That's an omission, right? He should have invested and he would have made billions, but he didn't. So what I started doing is I started becoming a student of the particular sector, and very specifically oil and gas. That's why you know me as Mr. Oxy, right? So when I was following the oil and gas sector, this is how most of you probably came to know me if you've been following the channel as Mr. Oxy, right? I looked at Occidental Petroleum and I thought, this is too good to be true. So effectively what I did was when I exited some of those positions, and I just shared with you which were my biggest losers, I was looking for something else that I could potentially buy into. Some of them were just simple buy and holds, high yielding savings accounts, right? I often share those with you where I say, I hold this because it pays a high dividend and I just view it as a high yielding savings account. Sometimes I get some stock appreciation as well, and it's great. Sometimes I do not because the stock pulls back, but I'm still banking the dividend. So it's a high yielding savings account. But in between, what I'm looking for is I'm looking for stocks within my little sandbox, within my little basket of expertise, which is limited. But what I'm looking for is specifically things that I know about, right? So I'm looking for those Occidental Petroleums or similar type of companies where I can make that investment and get that 6, 8, 10x return, which I missed out on some of these that I just showed you because I sold them. I sold them too soon. It's one of the disadvantages of using technology like covered calls or trailing stops, exiting the position at a profit, because you feel good when you do it. And I'll give you an example, a practical example, which I did not share with you. Approximately 2012, right? So about 12 years ago, I opened a position in Microsoft. It was a relatively small position. And my cost basis was around $23, maybe $24. And when it got to about $48, which is 100% gain, after a few years, which was quite quick, by the way, I bought it for like, let's call it, just to make it a round number, I bought it for 24. And just a couple of years later, it was trading at 28, at 48. So it's 2 times, right? So I'm up 100%. And I'm looking at this going like, hey, you know what? I'm happy with 48. If it goes up any higher, I'll plug in a trailing stop and sit on that gain for a while. But if it pulls back 5%, then I'll exit the position. Well, Microsoft went up to about $50 in my portfolio, and then it pulled back about $2.50 over a few weeks or so. And my trailing stop, which was 5%, kicked in, and I exited the position. Let's call it at $48, right? So I feel good because, like, hey, man, I sold Microsoft and made 100% gain on my original position. Now, remember, no one gets poor taking profit. But the thing is this, if I had done nothing, and I hadn't exited the position and just held on to it today, well, you could look it up if you like, see what Microsoft is trading at, and you say to yourself, like, say to me, if you'd like, just challenge me, say, hey, Mr. Oxy, how did you apply the opportunity cost of your exit on Microsoft into something else? What did you invest in? And did you make money on that or not? So remember, rule number 1, don't lose money. Rule number 2, never forget rule number 1. On that note, guys, thanks for watching. It's good to see you all, and I'll chat with you in the comments. Bye-bye.